Hello and welcome to the Killik Co market update. This week, the ongoing saga between Disney, Comcast, 21st Century Fox and Sky is finally drawing to a close. And the bidding war we've seen here really highlights the value of content in today's society. So let's just go back and take a look at the story so far. So 21st Century Fox owns a 39% stake in Sky. Both Disney and Comcast have bid for 21st Century Fox. Disney won that bid, so Disney will be acquiring 21st Century Fox, including that 39% stake in Sky. Disney and Comcast then bid for the 61% of Sky that is not owned by 21st Century Fox. That was quite a high-scale bidding war. The price was raised several times by both parties. It finally went to auction last weekend and Comcast won the bid. And I think the market is quite surprised at how much Comcast was willing to pay for that 61% stake in Sky. Now that that's gone through, Disney has said it will also sell the other 39% of Sky to Comcast. So Comcast will become the majority owner of Sky. So where does that leave both companies? Well, Comcast will become the world's largest pay TV provider. It will now have exposure to Europe as well as the US, and it will also have exposure to Premier League football rights. So the management believe that's quite an important step for the future growth of Comcast. Disney will have a majority stake in Hulu, the streaming app, which also makes its own content, for example, The Handmaid's Tale. We'll also have lots of new film content from Fox, including Avatar and X-Men, both of which have several sequels in the pipeline. And it will also have access to new TV shows, for example, The Simpsons, Modern Family, and also American Crime Story. So with all this new content, it really does look as though Disney is shaping up to be a genuine threat to Netflix. And also this week, we've had the Labour Party conference in Liverpool, so I think investors have been focusing on this quite closely and looking to see what potential new policies Labour will come out with. So one of the main ones they've focused on was one we've known about for quite some time, the nationalisation of utility companies, particularly water companies. What's quite uncertain is how Labour would plan to do this, how it would be paid for, bearing in mind that the UK economy also has quite a lot of debt, and also how existing shareholders would be treated and whether or not they'd get a fair price. Because there is so much uncertainty here, I think if Labour did come into power, you would see some weakness in utilities and water stocks because people just don't know how Labour would treat those. Other new policies include potentially free childcare for children ages 2, 3 and 4, and also a commitment to maintain the triple lock on the pension. So these policies are likely to be popular with both young parents and people of state pension age, but again what's uncertain is how these would be paid for. They are potentially quite expensive policies, and as just mentioned, the UK already does have quite a high amount of debt. The final policy, I think, was one that did shock the market quite a lot. Labour have said they would like to force large UK-listed companies to put 10% of their shares into a so-called inclusive ownership fund. Dividends from this fund would be paid to employees up to a maximum of £500 per year per employee, and the remaining dividends would be paid to the state. And business leaders really have been quite critical of this policy, and many have speculated that if this were to be enforced, a lot of UK-listed companies would move their headquarters and their stock market listings away from the UK. So many business leaders really think this policy would be damaging to the overall UK economy. And also this week, the Office for National Statistics has released some information about the UK's life expectancy rates. And it does appear that we're no longer seeing any growth here. If you have a look at these charts, you can see that since 2002, there has been quite a notable growth rate in life expectancy for both men and women. However, 2017 was the first year in which we saw no growth. There are perhaps a number of different reasons for this. Some are saying it's just a data blip. Others are saying it's because there's been a cut in social security benefits, and still others are saying that it's because there has been a rise in obesity-related conditions such as diabetes. But whatever the reason, if we do continue to see declines in the growth of life expectancy, this could potentially be good news for annuity providers such as Prudential and Legal & General. So these companies work by offering annuities to consumers, and they base those annuities on the life expectancy of those particular customers. If people die sooner than expected, then these companies will have to pay out less, and therefore they'll have more cash retained on their balance sheet. So this bad news about life expectancy could potentially be good news for companies in that sector. Now moving on to the week ahead, again it's a fairly quiet week for us here, but we are looking forward to results from PepsiCo, Tesco and Ferguson. That's it from us. Have a great weekend and we'll see you next Friday.